at not just retirement as being the long, in many cases, 30, 40-year runway that you have ahead of you, but break it down into the 5 years before retirement and then the 5 years into retirement. And there's two risks that are really going to surround that period of time, that red zone. And that is, number one, funded status risk. That is just investors, typically their failure to sit down and match their current assets with what they anticipate their long-term liabilities to be. They've spent many years saving, and the focus has been on growth, growth, and growth. And by the time they get to the point where they need to take distributions, have they factored in the future impact of inflation? Have they factored in their stomach for risk and volatility? And do they know if that asset base is going to be able to, maintain their lifestyle for, like I said, what can be 30, 40 years in some case?
Sure.
Secondly, which is really big, and there's been a lot of great studies that have come out recently around this, is return sequence risk. And that gets into the 5 years after your retirement date as well. And that's the impact that large market movements to the downside have on your future funding ability, if they occur early on, in retirement. So those that retired in '07, they saw, if they were heavy in equities, if they were kind of chasing the returns of the markets, they lost in some cases half of their nest egg. Yeah. You're almost better off experiencing those types of losses further down the road than you are right upon retirement. So that absolutely has to be quantified. Well, risk can be seen as a questionnaire on a sheet of paper that tells you if you're conservative or aggressive. But I think risk is a function of two inputs. There's your ability to take risk, which is based on the 2 points I just made in terms of funded status, your assets versus your liabilities, but also your stomach for risk, but taking a more realistic look at that. Today, if you take a typical risk tolerance questionnaire in a rising market environment, most investors will come out as being as aggressive. Everyone wants to be aggressive when the market's doing well. But I think investors need to kind of think outside the box a little bit and try and quantify in their minds what's the worst case scenario. At what point would I really feel like I'd be running for the hills and pulling money out of my portfolio, because that is more devastating, going to cash and being in cash for long periods of time and missing out on growth, then sometimes the market drops themselves. Fantastic point. I think you've got to show them the numbers.
Yeah.
I think you've got to take the time to put it on paper to them and say, okay, we know what your asset base is going to be at retirement. Let's shave 30% off of that. How does that impact your long-term ability to fund your retirement? Yeah. And the numbers are going to, put things into perspective a lot differently than saying, do you want more money in stocks or more money in bonds today? The biggest driver there is single stock concentration, and that's at the executive level, and that gets down into any employee of the company who's given shares. A lot of times, those that are holding company stock will say, okay, here's my bucket of my, let's say, Coca-Cola shares, and then here is my investment portfolio. It's very important to look at those two together and say, what's the risk that I'm facing in my company shares? A realistic look at what the risk is. What sector exposure do I have? What size exposure? Is it a large cap company or a small cap company? And how is that volatility, how is that risk composition going to work with the rest of my holdings? And how can I position my satellite portfolio to balance well around my company shares?
Thank you.